Over the course of 2025, an unsettling pattern has quietly and increasingly emerged across China. Small and medium-sized banks, once scattered throughout nearly every province and county, have begun disappearing at a pace never seen before. What many citizens initially dismissed as random closures or simple restructuring has now been confirmed by data. China's local banking system is undergoing one of the most severe contractions in its history. Between January and May 2025 alone, 184 small and medium-sized banks vanished from the financial map. That figure exceeds 7 times the total number of closures reported for all of 2024. By mid-October, the number surpassed 300, signaling a structural collapse rather than a normal business cycle. Meanwhile, on city streets, handwritten posters and small advertisements started appearing, most of them saying, "Banks have stopped lending. Mortgage approvals frozen. Need cash? Alternative financing available." These seemingly scattered signals all point to the same truth. The financial system is running out of money. At first glance, this phenomenon might appear to be merely a shift in market structure. In reality, it is the symptom of a deeper systemic breakdown. To understand how China reached this point, it is necessary to look at the pressure building beneath the surface: non-performing loans, shrinking profit margins, local government debt, collapsing real estate companies, and widespread declines in fiscal revenue. Before we begin, we want to hear your voice. If you agree that these stories reveal a deeper crisis inside China's economy and infrastructure, comment 1. If you believe the situation is exaggerated or see it differently, comment 2. Your engagement helps this investigation reach more people, so please like, subscribe, and share this video. Now, let's dive into the unfolding reality that China is struggling to hide. Bad loans are surging, and the banking system is running out of room. According to China's financial regulators, the total volume of non-performing loans, NPLs, held by commercial banks has already climbed to approximately 3.5 trillion yuan, increasing by nearly 90 billion yuan in a single quarter. The NPL ratio also climbed from 1.49% to 1.52%. Though the official numbers may seem small, analysts widely believe these figures are drastically understated. Worse still is the category known as special mention loans, loans that have not yet defaulted but are highly likely to go bad. That category has risen to 2.2%, meaning a growing portion of bank assets is sitting on the edge of default. These bad loans disproportionately hit city-level commercial banks, rural commercial banks, privately operated small banks, all of which collectively serve hundreds of millions of small business owners, farmers, and ordinary households. When these banks fail, the communities depending on them collapse with them. China's net interest margin has fallen to a breaking point. A crucial measurement of banking health is the net interest margin, NIM, the difference between what banks earn from interest and what they must pay to depositors. NIM is the lifeline of the banking sector. By Q3 2025, China's NIM stood at 1.42%, the lowest in modern Chinese history. When NIM falls too low, banks cannot cover operational costs. Banks cannot absorb future bad loans. Every new loan issued becomes a risk. Banks lose the ability to survive even minor shocks. China expert Wang He explained that at 1.2%, banks are operating at the edge of financial viability. The rising bad loan ratio of 1.52% means that losses now exceed interest income. He warns that the system is dangerously close to a crisis point. More worrying, operational cash flow for China's 6 major state-owned banks has already turned negative, something unprecedented. When the strongest institutions show signs of distress, Smaller banks stand almost no chance. Interest rates are at historical lows, and banks are losing money on every new loan. Due to government pressure to sustain economic activity, banks have been forced to lower interest rates year after year. Corporate loans, 3.1%. Mortgage loans, 3.1%. These are some of the lowest rates ever recorded in China. But banks face three unavoidable costs every time they issue a loan. Deposit cost, interest paid to depositors. Credit risk, losses from borrower defaults. Operating cost, staff, branches, compliance, and infrastructure. When loan interest falls below the cost of funds, banks lose money by simply lending. By late 2024, analysts noticed China entering an inverted interest situation. Loan rates lower than the cost required to sustain them. Regulators eventually stepped in to stop mortgage rates from falling any further. But the damage was done. Bank profit margins evaporated. Big banks are growing. Small banks are dying. A widening divide is emerging. Large state-owned banks reported 10% asset growth, far above the national banking average of 4.7%. Their share of total industry assets rose to 43.9%. Meanwhile, joint stock banks and small regional banks saw their asset share shrink. In plain terms, big banks are becoming bigger. Small banks are being squeezed out. This pattern reflects policy. Regulators believe it is safer to let weak institutions disappear and allow financial power to consolidate into a few major entities. But this consolidation also creates a greater systemic risk. When fewer banks hold most of the nation's assets, a crisis in one major bank could trigger widespread collapse. In mid-November 2025, a single muffled explosion in Henan captured the deeper truth behind China's so-called infrastructure miracle. At dawn on November 15th, a steel structure at BYD's superfactory expansion site in the Zhengzhou Airport economic zone suddenly collapsed. 3 workers were crushed to death instantly. Yet, what followed was not outrage or accountability, but silence. Local media said nothing. Social platforms remained calm. Only a terse 2-sentence notice from the Henan Housing Department acknowledged the incident, stripped of details, images, or responsibility. A project designed to produce 1 million vehicles a year had partially collapsed, and authorities treated the deaths as an inconvenient footnote. This was not an isolated tragedy. It revealed the architecture of a broken development model built on speed, political achievement, and systematic cost-cutting. The collapsed BYD site had been celebrated as an example of Henan speed, completing work in 17 months that normally requires 3 or 4 years. But that same speed meant safety nets were optional extra costs. Supervision firms pocketed fees while ignoring violations, and construction work was subcontracted through multiple layers until the final teams had neither the money nor the incentive to maintain basic safety practices. In a political environment where investment attraction is everything, regulators simply stepped aside. Approvals were fast-tracked, inspections became rituals, and with 70 billion yuan of investment on the line, no one dared slow the process. Just days later, another symbol of China's development frenzy collapsed, this time in plain sight. On November 17th, a newly opened long-for commercial complex in Xi'an, hailed as a landmark project with billions invested, saw a 30-square-meter ceiling panel tear away above an escalator. Gypsum boards and steel frames crashed onto families and children. The mall had opened only 3 days earlier. Videos showed chaos, dust clouds, people screaming and running. The cause was again the same: extreme underbidding, rushed schedules, subcontracting chains, and substandard materials. As construction workers themselves admitted, there is no lowest price anymore, only lower. Across China in 2025, similar incidents surfaced. A crane collapse in Chengdu that killed 5 workers, pedestrian bridges buckling, building facades falling off, and industrial sites turning into death traps. Whether in Henan, Xi'an, Chengdu, or Shenzhen, the common denominator was clear: a construction system where money flows downward while disaster rises upward. Workers dismantle cranes without safety ropes, operate 30 stories in the air without insurance, and sign contracts full of loopholes. When tragedy strikes, compensation becomes a battle almost no family wins. But the deepest danger is often invisible, embedded inside concrete, beneath rails, or hidden within beams. In November, a journalist investigating the Yinchuan-Baotou high-speed rail found rubber bearing pads so poor that they could be torn apart by hand. Testing showed the material had only 15% of the required tensile strength. Instead of weather-resistant EPDM rubber designed to last decades, builders used cheap isoprene mix, degrading rapidly under heat, cold, or pressure. Workers admitted the materials would fail after one winter. Experts warned that with such weak components, bridges could develop fatigue cracks when trains pass at 300 km/h, reducing structural lifespan by decades. The problem was not accidental. It was systemic. Suppliers mixed recycled scraps, subcontractors slashed prices, and inspectors stamped qualified on logs that bore no resemblance to reality. These failures are not rare accidents, as officials often declare. They are engineered outcomes of a system that prizes speed over safety, cost savings over quality, and political achievements over human lives. In China's infrastructure model, local officials chase rapid GDP growth and investment figures that determine their careers. Supervising companies are hired and paid by the contractors they're supposed to police. Inspections and safety checks are often fabricated after the fact. Multi-layer subcontracting drains budgets and accountability at every level. Workers and ordinary citizens bear the deadly consequences of decisions they never made. China has built the tallest buildings, the longest bridges, the largest factories, and the densest high-speed rail network in the world. But the rush to build fast, cheap, and politically impressive has hollowed out the very foundation of safety. From fake steel bars to collapsing malls, from failing cranes to defective high-speed rail components, the pattern reflects structural rot, not isolated mistakes. What collapsed in Henan, Xi'an, and Yinchuan were not merely structures. They were symptoms of a model where shortcuts are rewarded, oversight is ornamental, and lives are expendable. Until the incentives change, until supervision becomes genuinely independent, and until safety is treated as a non-negotiable foundation, more tragedies will come, each labeled unexpected, each hidden as soon as possible, each leaving behind grieving families and another layer of dust covering preventable deaths. These are not natural disasters. These are man-made catastrophes, and they are the inevitable consequence of a system that builds faster than it cares. What is happening across China is not random, not accidental, and certainly not unforeseeable. From banks disappearing at record speed, to construction sites collapsing only days after opening, to high-speed rail components that can be torn apart with bare hands, all of it exposes a deeper truth. China's development model is exhausting itself. This is not simply an economic downturn. It is the unraveling of a system built on speed, political performance, and silence. A system where accountability is optional, oversight is ornamental, and human life is the cheapest material on the construction site. If these patterns continue, and all data suggests they will, China is heading toward a structural crisis that affects finance, infrastructure, public safety, and the daily lives of ordinary citizens. What we are witnessing today may be only the beginning. If you want more uncensored, in-depth coverage of the stories China tries hardest to hide, please like, subscribe, and share this video. Your support keeps this work alive and ensures more people can see the truth behind the facade. See you in the next investigation, where we continue uncovering the realities no one else dares to talk about.